So there is this very specific kind of paralysis that sets in when you are sitting in the exam hall.
Oh, yeah, I know exactly what you mean.
Right. You're staring down this massive, high-stakes macroeconomics prompt, and it asks you to evaluate the RBI's policy stance for a given year, and your mind just completely blanks.
It's the worst. You can, vaguely picture the textbook charts, right? You see the trend lines.
Yeah. But the actual data points are completely blurry. And worse, the logic connecting those data points just evaporates under the pressure.
Well, it's a terrifying position, but it happens for a very predictable reason. We train ourselves to just memorize the raw outputs.
Just the spreadsheet figures.
Exactly, the headline percentages.
Yeah.
But we never internalize the underlying machinery. If you just force-feed your memory a list of disconnected stats, exam stress will wipe that clean.
Which is exactly why we are sitting down with you today. You are prepping for one of the most rigorous exams on the Indian economy and central banking.
And as your peers, analysts who have been through this exact gauntlet, we want to help you rebuild that foundation.
We are doing a deep dive exclusively into the fiscal year 2025-26. But we aren't just reading off the RBI Annual Report's economic review.
No, that would be useless.
Right. Instead, we're going to cross-reference every single central bank action with the functions and working of the RBI manual, the F&W document.
Because that manual is essentially the statutory DNA of the central bank.
Exactly. If you can explain to the examiner not just what the RBI did, but legally why they had to do it.
Then you move from a passing grade to top-tier mastery. And the 2025-26 fiscal year is honestly the most fascinating stress test of that DNA we've ever seen.
It really presents this massive macroeconomic paradox that examiners are definitely going to test you on.
So let's just lay out that paradox right now.
Yeah, because it's the central mystery of this whole session.
Yeah.
Think about the global economy that year. It was practically tearing itself apart.
Severe geopolitical conflicts, completely disrupted trade routes.
Huge threat of retaliatory tariffs. But the Indian economy didn't just survive that storm. It expanded at a massive 7.6% growth rate.
Which is wild. But here is the truly counterintuitive part. While printing that 7.6% growth, headline inflation actually crashed down to a historic low of 2.1%.
Right, and if you look at classical macroeconomic theory, like the Phillips curve, that is not supposed to happen.
It really isn't. High growth usually runs the engine hot, right? It drives up demand for labor and materials, which triggers inflation.
You normally have to choose between robust growth or stable prices.
Exactly. Achieving both simultaneously, like managing all that liquidity while pulling inflation down to 2.1%, that requires incredibly surgical monetary policy.
So we need to reverse engineer that surgery for you. But to understand how India built this high-growth bubble, we first have to look at the global headwinds.
The hostility of the outside environment.
Yeah. In 2025, global economic growth ticked up very slightly to 3.4% compared to 3.3% in 2024, and global inflation cooled to 4.1%.
Which on the surface sounds like stabilization.
Right, and global trade volume even recovered to a 5.1% growth rate. But I know that data is deceptive.
It is incredibly deceptive, and it's exactly where an examiner will try to trap you.
How so?
That 5.1% trade recovery wasn't driven by organic consumer demand. It was a fragile anomaly driven by the front-loading of imports and a temporary surge in tech exports.
Okay, let's break down that front-loading mechanism. Because essentially we are talking about corporate panic.
Right, about panic, yes.
Like if I'm a global manufacturer and I see storm clouds gathering over major shipping straits, or I hear tariff threats, I'm going to order a year's worth of inventory right now.
Exactly. You pull future demand into the present to avoid supply chain collapse.
Yeah.
So companies were hoarding inventory.
Ah, I see.
And at the same time, there was this massive CapEx boom globally for AI infrastructure, semiconductors, cooling equipment. It was all shipping at record volumes.
But that creates a spike, not a sustainable baseline. Once the data centers are built and the warehouses are full, the orders just stop.
They do. Which brings us to the bleak 2026 projections. The forecast showed global trade volume slowing down drastically from 5.1% to a very sluggish 2.8%.
Ouch. And the primary drag there is the reemergence of geopolitical risk, specifically the West Asia conflict escalating in early 2026.
Right, because when you have instability there, you threaten two critical arteries, energy supply and maritime freight.
The physical rerouting of cargo ships. If freighters can't pass through the Red Sea safely, they have to go all the way around the Cape of Good Hope.
Which adds weeks to transit time.
And burns thousands of tons of extra bunker fuel. And insurance premiums skyrocket. All of that is a massive Negative supply shock.
Combine that physical friction with policy uncertainty around U.S. tariffs, and the global economy is essentially seizing up.
So for the exam, you have to establish this baseline. Global growth was hovering around a mediocre 3.4%, but global trade was highly volatile and trending down to 2.8%.
Right, which makes the Indian data point of 7.6% growth seem almost physically impossible.
It really does.
Yeah.
Up from 7.1% the previous year. People always use the word decoupling, but I hate that term.
Yeah, it's a bit misleading.
It makes it sound like India just magically floated away from the planet. If the global economy is a machine and the main drive belt is snapping, how does the Indian gear keep spinning faster?
Think of it less like floating and more like a massive industrial flywheel.
Flywheel. Okay.
The flywheel stores rotational energy. If you have a small gear attached to a faltering motor, it stutters when the motor does.
Right, obviously.
But a flywheel has immense internal mass. Once it gets spinning, its own momentum sustains it for a long time, independent of the external motor.
So in 2025-26, India's internal mass, its domestic macroeconomic fundamentals, provided that momentum.
Exactly.
But look, I have to challenge that. A flywheel eventually loses energy to friction if nothing powers it. If our exports are facing those same global headwinds, where is the fresh kinetic energy coming from to hit 7.6%?
That is the core structural question. To answer it, we have to look under the hood at the real economy's demand and supply dynamics.
Let's do it. On the demand side, the numbers are telling. Private final consumption expenditure, PFCE, grew by an aggressive 7.7%.
A huge number.
And gross fixed capital formation, GFCF, grew by 7.1%. But right on cue with our trade analysis, net exports dragged the economy down by 0.1 percentage points.
And this is where you connect the data to the statutory intent. The F&W manual lays out the RBI's mandate, which explicitly includes fostering inclusive growth and development.
Right. It's not just about defending the rupee.
No, exactly. That 7.7% jump in PFCE is the primary engine. It represents the everyday spending of Indian households.
Let's visualize that for the listener. It's not just a spreadsheet number. It's a family in a Tier 2 city upgrading to a compact car.
Or a surge in domestic tourism, people booking flights internally.
Right. Or massive adoption of broadband. When a billion-plus population increases internal consumption by almost 8%, it forces domestic factories to produce more, totally ignoring whether Europe is buying anything.
And that consumer demand directly fuels the GFCF, the capital formation, which grew at 7.1%.
Because corporations see that demand and realize they need to expand capacity.
Exactly. They build new plants, buy heavy machinery. And concurrently, the government is executing massive CapEx programs, building highways and freight corridors.
So if the goods trade deficit is the external drag, domestic consumption and capital expenditure are the twin pistons driving us forward.
And this is crucial. The supply side didn't see a uniform boom. We saw a stark divergence.
Right. Manufacturing and services were booming, but the agricultural sector was subdued.
And examiners expect you to analyze that vulnerability deeply. Agriculture is inherently tied to uncontrollable variables, mainly extreme weather.
Right. Erratic monsoons and temperature anomalies hit them hard that year.
Which introduces a massive risk to our flywheel analogy.
Because if a huge chunk of the population relies on agriculture, a subdued sector compresses rural incomes. If rural incomes drop, rural consumption drops.
Oh, exactly.
So how did PFCE still hit 7.7% if the rural base was struggling?
The growth became highly asymmetrical. It was disproportionately driven by urban demand, fueled by those booming services and manufacturing sectors.
Oh, I see. The services sector, the digital backbone, saw huge wage growth. So the urban demographic had the disposable income to drive that 7.7%.
Yes, but your skepticism is spot on. Asymmetrical consumption growth is structurally unstable long-term.
Like an unbalanced engine block. If urban cylinders are firing at max, but the rural cylinder is misfiring, the engine will eventually vibrate itself to pieces.
Which is why policymakers look for medium-term catalysts to rebalance the load. You have to fix the drive belt. You have to turn net exports from a drag into a driver.
But how do you do that when global trade is sinking to 2.8%?
By altering the terms of trade through negotiations. This is where you bring the India-EU free trade agreement into your exam answer.
Okay, let's explore that FTA. Because an FTA doesn't magically create European demand. If Europe is in a slump, they buy less stuff overall.
True, but it changes India's relative competitiveness. Historically, Indian textiles faced high tariffs entering the EU compared to competitors with preferential access.
Right, so the FTA, those tariffs are slashed.
Exactly. So even if the total pie of European imports shrinks, India's slice gets much larger because our goods are suddenly dramatically cheaper for them.
We displace competitors. Plus, the FTA usually opens doors for the services sector, making it easier for Indian IT to get European contracts.
That's the dynamic to highlight. The macroeconomic design is to shift the burden. Over the next few years, net exports should flip to a positive contributor, taking pressure off domestic consumption.
So for the exam, don't just quote 7.6%. Deconstruct it. PFCE at 7.7, GFCF at 7.1. Contrast the booming services against subdued agriculture, and use the EU FTA to address sustainability.
Perfect. But exploring that intense domestic demand forces us to confront the great contradiction of this fiscal year.
Right, the inflation paradox.
Yeah, we just detailed an economy running incredibly hot, consumers buying, corporations building. That is the textbook definition of demand pull inflation.
Too much money chasing too few goods. But headline inflation didn't skyrocket, it plummeted to 2.1%.
Which is the most testable area of the RBI's mandate. To understand how we hit 2.1, we have to cross-reference the Flexible Inflation Targeting Framework, the FIT framework.
The bedrock of modern Indian monetary policy. Because prior to 2016, the RBI used a multiple indicator approach, right?
Yeah, they looked at growth, inflation, exchange rates, but without a rigid hierarchy. It made policy subjective and unpredictable.
To fix that, they amended the RBI Act in May 2016. Specifically, Section 45ZA.
Oh, you absolutely must memorize that citation, Section 45ZA.
It states the central government, with the RBI, determines the inflation target in terms of CPI once every 5 years.
And the statutory target is 4%, but they built in a tolerance band, recognizing that emerging economies face supply-side shocks.
Like the weather events hitting agriculture, so the lower tolerance limit is 2% and the upper is 6%.
Exactly. But here's the conceptual trap. If the target is 4% and inflation crashed to 2.1, did the RBI fail? Did they needlessly strangle the economy?
It's a great question, because 2.1 looks like a huge deviation. But you have to look at the strict legal definition of failure in the F&W document.
Right. Failure is defined as average inflation being outside the 2 to 6% band for 3 consecutive quarters.
A sustained 9-month breach.
Yes. Dipping to 2.1 at a point in time is not a failure. It's a profound success of disinflationary policy.
It anchored inflation expectations. People didn't panic buy, preventing a wage price spiral.
But we also have to explain mathematically how CPI dropped so low. You have to bifurcate headline inflation from core inflation.
Headline includes volatile food and fuel. Core strips those out. For headline plunged because of a sharp contraction in food prices.
But wait, agriculture was subdued, so why did food prices contract? This is where you explain the base effect.
The base effect. It's purely mathematical. Inflation is year on year. Let's say a drought in 2024 makes a vegetable basket jump from 100 rupees to 150.
A massive 50% inflation rate.
Right. Fast forward to 2025, Kharif sowing is decent, supply stabilizes, and the basket drops from 150 to 120.
The absolute price of 120 is still higher than the historical 100 norm. Consumers still feel pinched.
But mathematically, comparing 120 to last year's 150 is a 20% deflation in the data. That high base forces the current reading down.
Exactly. So that favorable base effect dragged headline food inflation down. But core inflation also dropped, largely due to a massive structural intervention, the September 2025 GST rationalization.
Fiscal policy, acting with monetary policy. The GST Council lowered tax brackets for key consumer goods.
If GST on motor vehicles or clothing is slashed, the retail price drops overnight, even if manufacturing costs haven't changed.
Which pushed closing inflation down to 2.2%, combined with cheaper global commodities like depressed cotton prices due to slowing global trade.
That's the nuance for a top-tier answer. Inflation dropped because a base effect in food coincided with a structural tax reduction on core goods.
It worked so well that the government retained the 4% target until March 2031.
Unequivocally working.
So on the RBI dashboard, inflation is a save 2.1%. Domestic engine is hot, but global headwinds are fierce. With inflation so low, they have maneuvering room.
They aren't fighting a defensive war against prices anymore. This leads into monetary policy operations. How did they deploy their tools?
They executed a highly synchronized easing. The MPC reduced the repo rate by a cumulative 100 basis points down to 5.25%.
Or 125 BPs if you look from February to December 2025. And crucially, they also reduced the cash reserve ratio, the CRR, by 100 basis points.
To show mastery, you must explain the transmission mechanism here, referencing Chapter 3 of the RBI Act. Let's start with the CRR cut.
Sure. Think of the banking system as an irrigation network. The RBI controls the main reservoir.
Right, and the CRR is a rule dictating how much water banks must keep locked behind the dam as unutilized cash with the RBI.
Earning zero interest. So if the system has tens of trillions of rupees, a 100 basis point cut unlocks hundreds of billions instantly.
It converts dead capital into flowing liquidity. We saw an 18.2% decline in banks' current account balances with the RBI.
That's the water leaving the reservoir. And bank treasurers now have massive cash reserves they need to generate yield on.
So they are forced to lend it out, driving down borrowing costs. And the repo rate cut acts as an accelerant.
Right, because the repo rate is the wholesale price of money. When the RBI lowers it to 5.25%, banks get cheaper capital.
They pass that on. Commercial banks lower their lending rates, NBFCs offer cheaper vehicle and personal loans, and boom, those puzzle pieces connect. Cheaper credit directly fuels the 7.7% PFCE and 7.1% GFCF we talked about.
The RBI literally engineered the domestic demand boom by opening the floodgates when inflation data allowed it.
But the timing of the policy stance is critical too. They shifted from neutral to accommodative in April 2025, then snapped back to neutral in June.
Which demonstrates their profound data dependence.
If driving is the analogy, neutral is coasting, accommodative is pressing the gas. Why press the gas in April and take your foot off 2 months later?
Because in April, global headwinds looked intensely severe and inflation was dropping fast. They saw a closing window to accommodate domestic growth.
To build a fortress against the global storm.
Exactly, so they pressed the gas. But by June, Q1 domestic GDP prints at a staggering 7.8%.
Wow, so the engine is running incredibly hot on its own.
But transmission of the rate cuts was fully operational. If they kept the stance accommodative, they risked overheating and igniting inflation.
So they agilely shift back to neutral, letting momentum carry them while monitoring stability. Tracing that sequence proves you understand policy is dynamic.
Definitely. Which leads to the next question. If the RBI injected all this liquidity, where is the money living?
Let's look at the financial markets and reserve money dynamics. RBI's net foreign assets expanded by 8.2 lakh crore.
Driven heavily by gold. By March 2026, gold's share in the NFA hit 17.2%.
Which is a highly strategic defensive posture. Why buy physical gold in the modern era? Because it has zero counterparty risk.
Exactly. With fracturing supply chains and geopolitical tensions, foreign bonds could be frozen or sanctioned.
But a physical gold bar holds universal value. The RBI was building an armored bulkhead.
But contrast the institutional defense with retail velocity. Retail digital payments grew 15.1% in value, but 26.9% in volume.
Millions of tiny microtransactions. The digital rails altered the currency to GDP ratio.
But the true test of financial maturity was in the equity markets. Mid and small caps were pressured, but the big story was foreign versus domestic capital.
FPIs, foreign portfolio investors, executed net sales of 2.7 lakh crore. They pulled massive amounts of money out.
Historically, that kind of capital flight triggers an absolute bloodbath. It crashes indices and weakens the rupee.
But the market absorbed it because domestic institutional investors, DIIs, bought 8.5 lakh crore worth of equities.
They completely overwhelmed the foreign panic selling.
Which ties back to the F&W mandate for financial market development. The RBI wants a deep domestic ecosystem so we aren't reliant on global capital.
And where did that 8.5 lakh crore come from? The DIIs are managing the pooled savings of Indian households.
Specifically through systematic investment plans, SIPs. The middle class shifted from hoarding physical gold to routing paychecks into mutual funds.
An automated river of domestic capital. When foreign funds panicked, domestic managers just bought the assets at a discount.
It's a permanent structural shift. But while equities are insulated, physical trade still requires management. Which brings us to the external sector.
The National Ledger. The headline is the current account deficit remained modest despite a widening goods trade deficit.
The CAD is the difference between money flowing in and out. As an industrializing nation, we import a lot of oil and machinery.
And with volatile energy prices, the dollar value of imports surged. It's a massive leak draining foreign exchange.
But the leak was plugged by two inflows: buoyant services exports and massive private transfer receipts.
Right, services being software development, IT consulting. Digitization is an existential requirement for Western corporations, so they keep buying our IT services.
But the truly fascinating lifeline is the private transfer receipts, the remittances. The RBI annual report highlights a very specific metric. The cost of sending $200 to India dropped to 5.3%.
That's better than the 6.4% global average, but still above the UN Sustainable Development Goal target of 3%.
And hitting that 3% is a critical macroeconomic imperative. Think about a worker in the UAE sending $200 home. At 5.3%, intermediaries siphon off $10.60.
Multiply that by millions of transactions, and that's billions of dollars of foreign exchange lost to friction.
If the RBI uses tech to bypass legacy intermediaries and hit 3%, billions of extra dollars flow directly into the economy.
It hits the family's bank account, boosting that 7.7% PFCE, and it flows into the RBI reserves, financing the trade deficit without issuing sovereign debt.
Pure efficiency. For the exam, anchor this to FEMA in 1999 and Sections 40 and 45W of the RBI Act. The RBI must manage reserves as a global financial safety net.
Reducing remittance friction perfectly executes that mandate. We should also mention FDI was $7.7 billion, though reserves did dip slightly as the RBI intervened to stabilize the rupee during global volatility.
Using the fortress walls to absorb the siege. So managing this complex economy in real time requires evolving past 20th century paper trails.
Which brings us to Section 7, Regulation, Stability, and FinTech, the modern RBI.
The traditional banking sector is resilient, NPAs are low, but the defining narrative is technological. The Unified Lending Interface, the ULI.
Handled by the Reserve Bank Innovation Hub. It crossed 9.6 crore API hits and onboarded 117 lenders.
It's like a universal translator for economic data. Think of a rural farmer needing a tractor loan. Historically, the bank uses credit scores he doesn't have.
The land registry uses an archaic database. Crop data is with a different ministry.
Gathering that takes weeks of manual underwriting. The friction makes the loan too expensive to issue.
But ULI provides standard digital rails. Using APIs, the bank's algorithm instantly pulls verified land deeds, satellite crop yields, and tax records.
A 3-week process takes 3 seconds. That is frictionless formal credit.
And this ties back to the RBI Act's preamble, mandating a modern monetary policy framework for a complex economy.
It's not just a cool app. They are legally obligated to pursue financial inclusion. ULI lowers underwriting costs, making rural credit viable and freeing farmers from moneylenders.
It's a national highway system for credit data. We also saw massive expansion in the central bank digital currency, CBDC, especially offline NFC and SMS solutions.
Because if a digital currency requires 5G and a smartphone, it excludes the exact people it should help. It must work on a $15 feature phone via text.
Offline functionality transforms CBDC into a genuine fiat replacement, and wholesale CBDC is settling certificates of deposit to eliminate settlement risk.
But digitizing the system exponentially increases cyber threats. Enter MuleHunter.ai.
Traditional software misses money mules because individual transactions look normal.
But MuleHunter uses machine learning to analyze millions of transactions simultaneously, finding anomalous behavioral patterns and severing their access.
So with ULI, CBDCs, and AI, is the RBI becoming a tech company?
It's a great conceptual question, but the F&W document answers it. Their mandate is financial stability and secure payment systems.
In 1934, that meant securing physical vaults. In 2026, the economy is on digital rails. To fulfill the 1934 mandate, they must control and secure those rails.
Exactly. So don't ignore the tech on your exam. Memorize ULI, RBIH, MuleHunter, offline CBDC. Link them all to systemic stability.
If you synthesize all this, it's a masterclass.
Let's recap briefly. We started with the paradox. Global economy dragging, India hitting 7.6% growth, driven by 7.7% PFCE and 7.1% GFCF.
We analyzed the surgical inflation fight. 2.1% wasn't a failure of the FIT mandate, but a triumph of managing base effects and GST cuts.
We explored unleashing liquidity via CRR and repo cuts, perfectly timed during an accommodative window.
We saw gold accumulate to 17.2% of NFA, and domestic S&Ps absorb massive foreign capital flight.
We examined the external fortress, using services and low-friction remittances to finance the goods deficit.
And finally, the blueprint for a frictionless digital infrastructure with ULI and CBDC. You now have the statutory DNA for all these numbers.
But before we wrap up, we have a conceptual challenge for you, something to mull over.
The F&W document acknowledges climate change and data monetization are blurring boundaries. Imagine a severe local heat wave decimating crops in one state.
A localized physical supply shock. spiking local food inflation.
But ULI is fully operational, and CBDCs are integrated globally. The affected farmers are instantly issued algorithmic microcredit.
And that credit is funded by instantaneous cross-border capital seeking yield.
Exactly. The local physical shock is instantly financed by borderless digital liquidity.
The physical world is localized, but the financial response is planetary.
So the philosophical question is, can a central bank manage financial stability by only pulling levers within its own borders anymore?
Right. Does digital public infrastructure render the geographically isolated central bank obsolete? Is the future inherently borderless?
If you can articulate that tension on your exam, showing how the RBI's tech sprint prepares for that future, examiners will be blown away.
Knowing historical data gets you a pass. Understanding the statutory DNA and projecting its future evolution is true mastery.
Trust the causal chain we built today.
You have the tools and the context. Best of luck on the exam. Keep analyzing the structures beneath the numbers, and we will see you on the other side.